Good morning, ladies and gentlemen, and welcome once more to the FT headquarters. I'm Yuri Bender, editor of Professional Wealth Management, and today I have with me a well-known figure in the field, Alan Miller. Alan was a star fund manager at Gartmore, Jupiter and New Star, much of the time working for the colourful John Duffield. Alan set up his own boutique wealth management group, SCM Private, together with his wife Gina in 2009, and they're already achieving a very high profile in the industry. Good morning, Alan.
Morning.
Alan, you were probably the UK's first hedge fund manager, and in your prime you were achieving annual returns of 17.5%, not to be sniffed at. What made you throw in the towel and say to your clients in your new venture, let's forget all about the active management, let's go predominantly passive, let's invest in exchange traded funds?
The hedge fund I started was UK equities. There were obviously a lot of hedge funds before me, but I think I was the first UK equities hedge fund. In a way, from my experience in different companies over many years, starting off actually in pensions in the 80s, we always found that we achieved good returns in the UK, and a lot of overseas markets we underperformed. And I always thought, well, actually there must be a better way to actually do what you're best at and index what you're not so good at. And I do think for active managers today, it's become much harder because the rules have changed. What's happened today over the last few years is that information is disseminated to everybody at the same time. So the edge which an active manager used to have of being nimble, seeing a company first, getting the information, kind of using common sense, has become much harder. And I think that's one of the reasons, if you look at performance over rolling periods, it's progressively getting worse and worse. And if you actually kind of invest for odds, invest for probabilities and say, what is my best chance of winning? If you actually invest in a nice, broadly diversified index, you achieve a higher return for less volatility, less risk, and I think that's what most investors actually really want.
So when you're having the conversations back in 2008 with some of the big private banks and the big names we're all familiar with, and you were looking at their investment strategies, what were you thinking about what they had to offer you in terms of potential returns, in terms of diversification, in terms of the type of strategies they were able to offer you?
I mean, what I personally wanted was to know that I wasn't buying the manager at their top. So I wanted to have a large amount of diversification. I wanted to take out those highs and lows. I didn't want to pay excessive costs and fees. And I found there wasn't available. And I always felt as a customer that I was being basically sold products rather than actually something which was right for me and a strategy that was right for me. It always felt almost as if I was walking into a supermarket where I was being tried to be sold the most profitable can of baked beans rather than what actually I wanted to consume from that supermarket. So I decided, to invest personally for the family, to build up our assets for our kids in the future. I wanted something which was incredibly well diversified not just by asset category, but the individual constituents of those assets, and cut out lots of the layers of costs and fees, have it invested in my own name so I could actually see it, so I could actually see exactly what I was actually investing in, something which is pretty hard to actually achieve from many managers, so that you have the confidence because you know there's a nice wide spread, you can see exactly where it's invested, and you can see the constituents of the funds you actually invest in on a daily basis. And that's what I wanted, so that's why we set it up, because we thought for a lot of customers, a lot of investors, a lot of individuals, charities, small institutions, that would be a successful way to invest over the long term.
So what you also seem to be saying, Alan, is that some of these big banks, they're making investment calls, they're telling customers to get into a particular kind of asset, but they're not putting their own money into the game. So they're not really following their own convictions, whereas you're managing your own money together with that of the clients.
Yes, and we don't have hundreds of different products or portfolios, because what we believe in is just doing a few things well and having a diversified selection within each portfolio. So we're not selling emerging market fund at the worst time, or corporate bonds at the worst time, or government bonds. We're selling, if you like, portfolios to actually invest in, which will change over time according to the circumstance, rather than the whole kind of thesis for a lot of these companies is basically selling product rather than actually designing something which is actually successful for the consumer and the investor over the medium to long term. So it's a completely different approach, because we approach everything from how we believe we want our money invested. And that's, if we don't want it invested that way, we will not do it. So it's a completely different mindset to how the large banks operate, maybe because they've got outside shareholders, maybe because they're trying to kind of generate high fees, you know, quarter on quarter. We can run it for the medium to long term, whereas the other people obviously get focused on the short term, and that counts against the investor.
But your old contrarian instincts from the hedge fund days must be going into overdrive at the moment, when you're reading on the front page of every newspaper that Europe, Greece, Spain is about to collapse,
yes,
and everybody should get out of the euro. And
yes,
does that mean that we should be doing totally the opposite?
Normally it does. I mean, normally when you see the front page headline, it's too late. So when you see the front page headline, the markets are doomed, the euro is finished, gold it will go up forever, it's normally 9 times out of 10 the wrong thing to do, because the price is effectively discounting what people think or worry about today. And what we try and do is look at the underlying fundamentals, have a nice spread, not have too much in any one particular asset or currency outside the UK for investing for UK individuals or charities, and therefore you take small measured steps. So when more value appears, when things get cheaper, then we add to it, and when things get more expensive and value is kind of falling away, then we tend to kind of sell it. And we do that in a measured way. So the whole point of our philosophy is to have a large spread and not, if you like, bet on one particular area or one particular kind of sector within one particular area, because that's the benefit we think we have in terms of people wanting to invest in a nice mix over the medium to long term. And if people want something more racy, more concentrated, we're not the people to invest with, and we do not pretend to do that.
Alan Miller, thank you very much.
Thank you.